Hey everyone, my name is Brooke Elder. I am the Director for Medical Office Administration and Office Management here at CCCNTI. But in addition to that, I am also a licensed real estate broker here in North Carolina. And your amazing math instructor, Dr. Holler, asked for me to put together a quick video going over some real estate information. So today's little mini lesson is going to be Real Estate 101 Understanding the Basics. So, as you're considering purchasing a home in the future, there are some general steps for the home buying process. And the very first thing that you would want to do before you even look at a house is to get a pre approval. You would want to do that through working with a lender. So, it could be your bank or it could be another company that offers out mortgages. You want to do this because that's going to tell you where you stand and how much you can afford. There's nothing worse than going out and looking at properties without knowing what you can afford and then making an offer, going under contract, wasting time, money, and energy, and realizing that you do not qualify for that loan. So, the very first thing that you want to do is you want to get pre approved. Then you should consider hiring a buyer's agent. That is going to be a real estate broker that represents you and not the seller. Then you're going to search for homes based on your must-haves that you want in that property, as well as based on your price. Then you will make an offer. Your agent will help you negotiate the price and terms. The terms are going to include what day are you going to close, how long is your due diligence period going to last for, is there anything in the house that you want to stay, such as this really nice stainless steel refrigerator, the washer and dryer. Was there a really cool zero turn out in the building that you would really like to have? All of those things are negotiable, and that would be part of your offer to purchase within reason, obviously. Then you're going to go into what we call the due diligence period. And typically that lasts about 15 to 30 days. The lower number, the fewer amount of days on the due diligence period is going to set you apart from other offers if you don't ask for a long due diligence period, because that is crunch time and that's the time that you have to get the house inspected, appraised, and then go through finalizing your loan. Once you go through that period, you'll eventually end up on closing day, and that is the most exciting day for everyone involved. And that's when you sign the papers, get your keys, and officially become a homeowner. So, one thing that you should know when you're going through this process is you want to make sure you protect yourself. Always make sure you're reading before you're signing, especially the offer to purchase. And in North Carolina, that is a 17-page legal document that outlines all of the terms of your offer to purchase. You want to use professional inspections to avoid costly surprises. So, things like your home inspection, which typically the home inspector will come out and look over everything and then make recommendations. So he might go on the roof as part of the normal home inspection and say, hey, you need to get a roofing company out here. So then that would lead to another inspection. They may go in the crawl space and find some water issues. So then you would want to get a crawl space specialist out to take a look at that. Pest companies could come out. Heating and air companies could come out. You want to go through and get all of the inspections that you can think of within reason, knowing that you would be responsible for paying for those inspections as the buyer, but you definitely want to do that and protect yourself so you know what you're buying, because in North Carolina, it is a buyer beware state. So that means that the seller does not have to tell you anything at all about the property. You have to figure it out yourself. Also, and last, as far as protecting yourself, don't make big financial changes like buying a car before you close, because it can affect your loan approval. And the reason why that is because that's going to go against your debt to income ratio, which we'll talk about in just a minute. So, know your numbers. Buying a home is as much about math as it is about real estate. You want to start by finding out how much you can afford, because that is going to tell you what you can and cannot look at. Lenders are going to look at your debt to income ratio, your credit score, and your down payment. Typically, for first-time home buyers, we're seeing a 3 to 5% down payment. There are some other things out there, such as USDA loans, that is in rural housing or rural areas, which we have a lot of property in our area that fall in the USDA map zone, and you can look up an address on the USDA's website. But sometimes those loans can go at 100% financing, meaning that you do not have to put a down payment down. But You just need to know that there is more to your mortgage than just the mortgage itself. There's going to be things like property taxes, insurance, if you're in a homeowners association, what the fees and maintenance might cost. And so that leads me to some things that are all about math when we're thinking through real estate. So again, the debt to income ratio is very important. Typically, we want to see that under 43%. We talked about the down payment. There's something called property mortgage insurance, or PMI. That is tied to certain types of loans and is based on credit scores and DTI. So the better off you are in a financial, the better off you are financially, then the unlikely chances that you would have to pay for PMI. But PMI is basically like an insurance that is attached to your mortgage, which is an additional charge, saying that if we have to go and foreclose on this property, we can start pulling from the PMI. And then you want to make sure that you're budgeting for all of these fees. So DTI, what is that? That's the debt to income ratio. And that is just saying that is how much of your money each month goes towards paying your bills and your debts compared to how much you make. So think of it like a pizza. If your whole pizza is your monthly income, what you make before taxes, the slices you give away are your monthly bills, like your car payment, student loans, credit cards, and your future house payment. Your debt to income ratio tells the bank how many slices of pizza are already taken before they give you a mortgage, right? So they need to know that you can afford it. So an example here is, let's say that you make $5,000 a month before taxes and you spend $2,000 a month on things like your car, student loans, and the house payment that you want. That means your debt to income ratio is around 40%, which is good. Most lenders want you to be under 43 to 45%. Obviously, the lower the better. The more house you're going to be able to afford. So, all right, let's move on to some other math concepts that you might see when thinking or when talking about real estate. So it's going to show up in things like percentages and ratios, like your down payment, your interest rate, and real estate commissions. That's the money that we would pay to the agent. So on the screen, I've got some examples. You'll see it in how you look at square footage and price per square foot. So you would take your square footage of your house, divide it by the price of the house, and that's going to tell you what your square footage would be. Also, if you're going to build a house, what it might cost to build a house based on what the builder charges per square foot. Then we have loan to value ratio, which is how much money, like kind of what's left over, what your equity in the home might look like, and that is going to affect your PMI. You also have interest over time, simple versus compounded interest. So that's just going to tell you, like, keeping in mind what you're going to be paying back over time. So for example, for a 30-year loan for $250,000 at a 6% interest rate, that means you're going to be paying back over $430,000. So that's why interest rates are very important. You want to get that as low as you possibly can. And then next, math is also helpful when considering measurements. So if we go into a house and we say, oh, this living room really needs new carpet, you could consider how much it might cost you based on knowing how to do the square footage of the room or the house itself. Then you want to know how to budget. So when you're budgeting for your mortgage, you need to know that your principal, interest, taxes, and insurance are all included. So if your total payment is $1,800, only about $1,200 might actually go to your loan, because the rest is going to go to taxes and insurance, which is typically held in an escrow account for you to make sure that that's getting paid for on your behalf while you have a mortgage with the bank. And then things like appreciation and depreciation. Typically, houses should be appreciating over time. We're not really seeing a whole lot of depreciating in houses in the market right now, whereas cars do depreciate as soon as you drive off the lot. You know that you're going to lose value. That is typically not the case with homes. So that is a great thing about when considering whether you're going to buy or rent. With rent, you're not getting anything back whenever you decide to leave that property. Whereas if you buy a house and sell a house, you're going to get some money back because it's going to appreciate. And then property taxes, with help with knowing the math, you can look at your county's tax rate and your home's value to figure out what your annual property taxes are if you would like to do so. And then we have return on investment, or ROI. This is just saying if you purchase a house for X amount of dollars and you spend X amount of dollars fixing it up, and you turn around and sell it for X amount of dollars, as shown in this example, that would show you what your return on investment is. So, whether you love math or not, it is the foundation of every home purchase. The better you understand these numbers, the smarter and more confident of a buyer that you will be. I hope this helps kind of go over a crash course on Real Estate 101. It gives you just a little bit of a tease on the topics, but also shows you how important it is to know some basic math concepts when you are in the home buying process. If you have any questions about any of this information, reach out to Dr. Holler, and I hope you guys have a great rest of your semester.